I have so much bad news I want to share with you guys in this video about the state of the economy. But finally, stocks are falling. Bitcoin has just corrected. And not to say that I'm happy with seeing stocks in Bitcoin fall, but at the same time, if this is something that you've been expecting and something that you've been preparing for, I've been waking up every morning seeing stocks in Bitcoin continuing to go up, avoiding the FOMO because I've been on the sidelines preparing, collecting my cash so that I can deploy it when stocks finally fall. Buy low, sell high. The past few months, it seemed like retail investors or dumb money were extremely bullish because they thought that the Fed was going to pivot soon because they were already lowering their interest rate hikes and that inflation was actually headed back down. We were in our next bull run and it was confirmed by this bear market rally we've had since January. However, I didn't believe this. I thought that things were actually going to get worse as we head deeper into 2023, mainly due to the lag effect of interest rates, which is something that I've talked a lot about on this channel. So definitely hit that thumbs up button and subscribe to the channel so that you don't miss any future videos. But I thought that things were going to get worse as we head deeper into 2023, and only once the Fed pivots, perhaps sometime in 2024, will things start making a turn for the better. So in this video, I want to share with you all of the bearish reasons, all of the things about why I think the stock market and crypto is headed down. The average everyday consumer, people like me and you, are really struggling with paying our bills. People are dipping into their savings, and that stimulus checks that we've received during the pandemic are drying up, and people are relying more and more on credit cards to be able to stay afloat. And what's crazy about credit cards is we know that the interest rates are insane, somewhere at around 20%, which is more on the low end, all the way up to 30%. That's just incredible to think that people are relying on this expensive loan in order to pay their everyday bills, which is just digging them deeper and deeper in a hole. Unemployment reports have recently came out. We're at 3.6% unemployment, which is actually extremely low unemployment. But the reason why it's so low is because these average everyday consumers are needing to pick up part-time jobs, multiple part-time jobs in order to make a little bit more money because their regular full-time job isn't bringing in enough money to be able to pay their bills. And so more people are working even harder to just stay afloat. And this bad situation is only going to keep getting worse because a lot of these consumers, they also have student loan debt on top of their credit card debt, and they haven't needed to pay on their student loan debt for the past couple of years with the student loan deferment program. But that program is going to end June 30th of 2023, which means they're going to have another bill every single month that they're going to need to start attending to. And if they're already struggling paying their bills, this is going to put them in an even worse position. And the layoffs are also looking to get worse as we head deeper into 2023 as companies start making less money and start laying off more employees. And it's been confirmed by Jerome Powell, the head of the Fed. He says that the labor market is going to soften as they continue to try to lower high inflation. More layoffs is going to happen. And so if the consumer loses their full-time job, which is likely the biggest part of their income, it's just going to put them in an even worse position. The reason why a lot of these consumers are having such a hard time paying their everyday bills in comparison to before is because of this hyperinflation that we've experienced since 2020 when the Fed printed trillions of dollars to stimulate the economy during the pandemic, which then it led to the raising of everyday items all across the board. If you want to go see your mechanic or any kind of service like going out to eat or seeing your doctor, prices have just kept going up. Going to the grocery store, going to the gas station, your utility bills, and the car craze that happened where just a regular average economy car, the prices just kept going up with the dealers just marking up all of these new cars as well as even used cars, prices just kept going up. And not to mention the housing market where the prices just kept going up to where the average everyday person was unable to even afford buying a house, mainly because with all of this hyperinflation, the income didn't go up and match all the things that the consumer had to spend their money on, which is leaving them in a very bad place. And now with this whole debt ceiling situation that's happening where the government needs to raise the debt ceiling because they've already hit the amount of money that they can spend and raise that debt ceiling in order order to borrow more money to be able to pay for all the things that it wants to pay for. So that's definitely not helping inflation. And so at the same time, the Fed is trying to fix this hyperinflation that we have going on by raising the federal funds rate or making money more expensive to borrow. So when they do that, this essentially tries to kill demand, which means that if it costs more money to buy something, then that means that people will less likely go out and try to buy it. Therefore, it kills demand. Therefore, it drops down the prices. At the same time, it also lowers the income and the profit of companies. Companies aren't making as much money as they used to. So now they're also thinking about laying off more employees because they just don't need all that manpower and that support in order to satisfy the demand that's not really there. And so that's why the economy is headed down, and it's looking very likely, it's almost inevitable that we're headed right into a recession. And with this high interest rate, you would think that housing market would crash by now, mainly because demand should be dead, mainly because if interest rates are high, that means people can't afford houses. So they're not looking for houses, which means it crushes demand, which means it lowers prices. So high interest rates have an effect in a very direct way when it comes to the housing market. But the reason why we haven't seen the housing market actually crash quite yet is because of all these people that were able to buy a house when interest rates were low. Now they have like a sub 3% interest rate. So if they were to go out now and sell their house, they would need to go buy another one and pick up an interest rate that was double the amount that they already had. So a lot of these people are just hanging on to their interest rate and not selling their houses, which means it keeps supply low. With not a lot of supply, the houses that are on the market continue to stay high. And so it's looking very likely for a correction to happen eventually over time when people are forced to sell their house. They don't want to sell their house, but when they're forced to sell it. So what would be a situation where they're forced to sell their house? Well, as I mentioned earlier, if layoffs are going to keep getting worse because companies aren't making as much money as they used to because the demand is dead, because inflation is running hot, and so the Fed is raising interest rates, people will get laid off at their jobs. And especially if these homeowners get laid off at their job, they're going to be forced to sell their house because they can't afford to pay their mortgage. And so if this happens to a lot of homeowners, then what's going to happen is the market is going to be flooded with all of these houses. And when there's more supply than there is demand, the prices of houses will fall. And now with this downturn in the economy so far, I really think that this is just the beginning. And at the moment, with the more recent news, the banks are starting to feel this tightening and this squeeze in the economy, with Silicon Valley Bank as well as Silvergate about to collapse and go bankrupt. So it's not looking good for banks and who's going to be next. And it's not looking good for the crypto market as well, with the more recent news of USDC getting unpegged to the US dollar, as well as just Bitcoin correcting. And when Bitcoin corrects, it also brings down the whole cryptocurrency market. We also have the situation with the war in the Ukraine as well as Russia. We have this Cold War going on with China, and now with the stock market about to head down and crypto about to head down, people's retirements are dwindling out. People that are in retirement now or might be thinking that they need to start heading back into the workforce because their retirement accounts, their portfolios just keep drying up. And so it's not looking good. So if you learned something in this video, definitely hit that thumbs up button, subscribe to the channel for more videos like these in the future. I'm really trying hard to get this channel monetized, so please help me out by subscribing. I need about 1,000 subscribers and 4,000 watch hours in order to get monetized. So thank you so much for your subscription. All right, guys, my name is Jimmy Invest, and I'll catch you in the next video. Peace.